High interest savings accounts are the easiest, most passive way to boost your income. You can literally make around 60% more in interest just by moving your money from a day-to-day current account into a high interest saving account. And it literally takes 5 minutes to do. And you can literally make hundreds, if not thousands, more every year in interest by doing this. In this video, I'm going to go through 3 reasons why you should use them and conclude with the downsides. But firstly, I've created this table to illustrate the different interest earnings between a current account at 3.25%, which is quite standard at the moment, against that of a standard instant access saver at 5.15%. So although the difference between the 3.25 and the 5.15% doesn't seem like that much, if you've got £5,000 saved, that's an extra £95 a year, or 50k, an extra £950 a year of income. Now I know we're not talking about life-changing amounts of money, but even if this takes at most 30 minutes to set up, and you've got £5,000 saved, you're talking about £95 for 30 minutes work that you then re-earn every year. That's the equivalent of earning £190 an hour. Now, full disclaimer, most experienced investors will say, no, high interest rate accounts are rubbish. You need to put all your money in an index fund or property investments at the very least. And to be honest, they're right. That is what I do in the most part. But in reality, the vast majority of us out there, and I'm hoping you watching too, aren't confident to or want to invest in anything like that. You've got money in the bank and you want to make sure it is safe, accessible until you need it, or until you might be ready in the future to invest in a business or a property and so on. On average in the UK, the average person has about £7,000 of savings. In the US, that's about $6,000. Generally, the older you are, the more savings you have. So for instance, the average savings for the over 55s in the UK is about £36,000 compared to in the US, it sits about $92,000. Ultimately, with these sorts of amounts, if you're younger with 5, 10, 15k of savings, you're probably going to want to make sure that money is accessible in case you need it for a rainy day or you're saving for a deposit for a house. If you're reaching retirement age, again, you're going to want to make sure that money is accessible. It isn't necessarily practical for you to lock your money in a longer term investment. But whatever your reasons, having money in a savings account rather than a current account is a no-brainer for these 3 reasons. 1, it is risk-free. If you have a savings account in a UK authorised bank, which is all your high street banks at the moment, you're covered up to £85,000 per person. So if the bank goes bust, you don't need to worry, as the government will step in and cover you. Literally 100% no risk. Secondly, it is tax-free. So up to a certain amount, that interest you earn is completely tax-free. So if you earn less than about £50,000, you pay tax at a basic rate. You can earn £1,000 tax-free, or if you earn above 50 to 125 grand, you can earn £500 tax-free. And obviously then if you earn above 125 grand, then you don't get anything tax-free, which is fair enough. But if you're earning more than 500 to £1,000 of interest, depending on which tax bracket you're in, you'll then need to pay tax on that additional amount. Now, I know earning £1,000 tax-free might not seem like a big saving, but if you're a basic taxpayer at 20%, you would have to earn £1,250 more in your job to get £1,000 after tax. The third final thing is it offsets inflation. The annoying thing about money is money gets less valuable as time goes on. A pound today will be less than a pound in a year's time, and that is because of inflation. We've all heard a lot about inflation over the last couple of years, and we've all been given a bit of an education of how inflation going up means prices going up. Inflation being too high means prices are increasing at too high a rate. Earning more interest on your savings helps. At the moment, inflation in the UK is 6.3%, when the Bank of England target is for it to be about 2%. So if you're earning 6.3% of interest, all that is happening is your money is maintaining its value year by year. If inflation drops to 2% target and your interest rate is higher than 2%, you're then making the difference. So the higher the rate of interest you can earn on your money, the more you are protecting yourself against the downsides of inflation. So in conclusion, what are the downsides? Well, nothing. Your money isn't trapped. It's in an instant access savings account that you can get to any time. So if you want to use that money, or you can earn more with that money by investing in something else, then you can. See you in the next video.